Expected 50% rise in foreign direct investment in U.S. startups, analysis of 3 key industry sectors by end of 2026. Introduction. Recent projections suggest that foreign direct investment FDI in U.S. startups is set to rise by 50% by the end of 2026. This anticipated growth is crucial for understanding the future landscape of global investment and innovation. Key factors driving this increase include favorable economic conditions, advancements in technology, and significant shifts towards automation and sustainability. This report will analyze the impact of these trends across 3 pivotal industry sectors: technology and automation, renewable energy, and semiconductors. 1. Growth projections and economic context. FDI has been with manufacturing being the largest recipient of these investments. The global FDI landscape is expected to recover modestly after experiencing a downturn attributed to geopolitical tensions and supply chain disruptions. The U.S. remains a primary target for this recovery due to its favorable corporate tax policies and the anticipated reduction of corporate taxes to a global minimum of 15%. This shift is particularly attractive to market-seeking and barrier-hopping investors. Key economic indicators. 2023, U.S. FDI increased by $227 billion, largely in manufacturing. 2024, stabilization of inflation and growth in global trade are expected. 2025, a modest recovery in global FDI is anticipated, influenced by improved economic conditions. 2026, a projected 50% rise in FDI in U.S. startups is expected, driven by advancements in technology and favorable investment policies. 2. Key industry sectors impacted by FDI. 2.1 Technology and automation. The technology and automation sector is poised to see the highest influx of FDI. Driven by the rapid integration of artificial intelligence (AI) and robotics in manufacturing processes. As traditional labor-intensive roles evolve, companies are increasingly adopting automated solutions to enhance productivity and reduce costs. Key trends. Industrial robotics. The global installation of industrial robots reached over 500,000 units annually in recent years, indicating a significant shift towards automated manufacturing. AI integration. Companies are investing heavily in AI-enabled technologies to streamline operations and enhance decision-making processes. 2.2 Renewable energy. The renewable energy sector is another critical area expected to attract substantial FDI. As the global economy shifts towards sustainability, investments in green technologies are becoming increasingly important. Key trends. Investment growth. Although FDI in renewable energy is projected to slow down, it remains a top priority for many investors focused on long-term sustainability goals. Government support, policy changes, and investment incentives at both state and federal levels are designed to attract foreign investment into renewable energy initiatives. 2.3 Semiconductors. The semiconductor industry is experiencing a renaissance driven by the increasing demand for advanced technology in various sectors, including consumer electronics, automotive, and telecommunications. Key trends. Market demand. The rise of 5G technology and the Internet of Things (IoT) has created a surge in semiconductor demand, prompting significant investments. Supply chain resilience. In light of recent global supply chain challenges, investments are being funneled into domestic semiconductor production to enhance resilience and reduce dependency on foreign supply chains. 3. Risks and challenges. Despite the optimistic outlook for FDI growth in U.S. startups, several risks and challenges could impede progress. Geopolitical tensions, ongoing conflicts, and trade wars could disrupt supply chains and create uncertainty in investment climates. Tightening immigration policies. Stricter immigration laws in the U.S. may limit the availability of skilled labor, pushing companies to rely more on capital-intensive investments rather than labor-driven projects. Economic volatility. while inflation is expected to stabilize, unforeseen economic shocks could still impact global investment flows. 4. Conclusion. The projected 50% rise in FDI in U.S. startups by the end of 2026 reflects a significant opportunity for growth across key sectors such as technology and automation, renewable energy, and semiconductors. However, stakeholders must remain vigilant in navigating the challenges posed by geopolitical risks, policy changes, and economic volatility as the investment landscape continues to evolve. The interplay of favorable economic conditions and technological advancements will be critical in maximizing opportunities and driving sustainable growth in the U.S. startup ecosystem. References: 1. FDI Intelligence. 2024 Global FDI Prospects for 2025. 2. U.S. Bureau of Economic Analysis. 2023 Direct Investment by Country and Industry. The anticipated 50% rise in foreign direct investment (FDI) in U.S. startups by the end of 2026 reveals several counterintuitive insights. 1. Fragmented recovery amid optimism. While the overall sentiment towards FDI is optimistic, the recovery is expected to be structural rather than expansive. This means that although there is an uptick in investment, it is not necessarily indicative of a robust economic rebound. Investors may be focusing on specific sectors or types of investments rather than a broad-based recovery, highlighting a nuanced understanding of market dynamics. 2. Easing restrictions versus rising geopolitical tensions. The easing of FDI restrictions in the U.S. and other nations is expected to enhance the investment environment. However, this occurs in tandem with rising geopolitical tensions that could disrupt these benefits. This duality, where relaxing policies may not be enough to counteract geopolitical risks, presents a paradox in the investment landscape. 3. Impact of automation and labor supply. The tightening of immigration policies in the U.S. is expected to lead to a shift from labor-intensive projects to more capital-intensive investments such as automation and robotics. This counters the traditional view that FDI typically creates jobs, suggesting that an increase in FDI may not correlate with job growth in certain sectors. Instead, investment may increasingly focus on technologies that reduce reliance on human labor. For sector-specific investment trends, the anticipated highest inflows of FDI into renewable energy, communications, and semiconductors may seem logical given current global trends. However, the expected stagnation in traditional sectors like real estate and transportation raises questions about long-term investment strategies. This suggests that investors may be prioritizing innovative sectors while sidelining more established industries, which could lead to an uneven economic landscape. 5. Resilience-driven diversification. The restructuring of global value chains due to resilience-driven diversification may appear to be a proactive measure. Yet this fragmentation could lead to inefficiencies and increased costs in the long run, countering the immediate benefits of diversification. Investors may be moving towards localized production, which could conflict with the historical trend of globalization. 6. Non-equity investment modes. The rise in non-equity modes of investment, such as contract manufacturing and franchising, indicates a shift towards risk-averse strategies. This could be seen as a departure from traditional equity investments, reflecting a cautious approach amidst uncertainties. The trend suggests that investors may prioritize flexibility and lower risk over direct ownership, which challenges conventional understandings of FDI dynamics. 7. Service sector dominance. The significant share of FDI directed towards the service sector, accounting for 72% of total FDI stock, contrasts with traditional views that often focus on manufacturing and resource extraction as primary targets for foreign investment. This shift indicates a broader transformation in economic structures where services increasingly dominate, reshaping expectations around FDI impact. 8. Emerging markets versus developed economies. The expectation that protectionism in developed markets will push FDI towards emerging markets might seem straightforward. However, this could lead to over-reliance on less stable markets. which may not provide the same level of return or security as investments in developed economies. The interplay between risk and reward in these scenarios presents an interesting contradiction. These counterintuitive insights reveal the complexities and multifaceted nature of the expected rise in FDI, emphasizing the need for nuanced analysis in the evolving landscape of global investment. Investors must navigate these contradictions to make informed decisions amidst shifting economic realities. The report on the expected 50% rise in foreign direct investment FDI in U.S. startups by the end of 2026 contains several critical insights that may be overlooked by many readers. Here are some of these key points along with explanations of their significance. 1. Structural growth versus expansive growth. The report emphasizes that the anticipated recovery in global FDI is expected to be structural rather than expansive. This distinction is crucial because it suggests that while FDI may increase, the nature of this growth will not be uniform or robust across all sectors. Understanding this nuance can help investors and policymakers tailor their strategies to focus on sectors that are likely to see stable growth, such as technology and renewable energy, rather than expecting a broad-based surge in all industries. 2. Investment drivers in technology and automation. A significant driver for FDI growth is the acceleration of investment in technology and automation. This transition is not merely a trend but a fundamental shift in how industries operate. The rising integration of AI and industrial robotics is transforming traditional manufacturing processes, and companies that fail to adapt may find themselves at a competitive disadvantage. This transformation can lead to increased productivity and lower operational costs, making these sectors particularly attractive for foreign investors. 3. Impact of policy changes. The report discusses the easing of FDI restrictions and favorable new policies in various countries, including the U.S. Notably, the reduction of corporate taxes to a global minimum of 15% is highlighted. This policy shift could significantly alter the investment landscape, making it imperative for stakeholders to remain updated on legislative changes. Ignoring these developments could lead to missed opportunities for capitalizing on favorable conditions for investment. 4. Sector-specific insights. The report identifies renewable energy, communications, and semiconductors as the sectors likely to receive the highest FDI inflows. This detail is significant because it allows investors to focus their resources and strategies on industries that are expected to thrive in the coming years. Conversely, sectors like real estate and transportation are predicted to experience stagnation, which could inform strategic divestments or cautious investments in those areas. 5. Geopolitical risks and supply chain disruptions. The report outlines the risks posed by rising geopolitical tensions and potential supply chain disruptions. This aspect is often overlooked in optimistic projections about FDI growth. Understanding these risks is vital for investors, as they can have immediate and drastic effects on investment viability. For instance, conflicts in key regions could disrupt supply chains, affecting the profitability of investments and necessitating contingency planning. 6. Tightening immigration policies. The anticipated tightening of immigration policies in the U.S. is a critical factor that may lead to a shift from labor-intensive to capital-intensive investments. This change underscores the importance of understanding the labor market dynamics and how they can influence investment decisions. Investors focusing on sectors that traditionally rely on labor may need to reconsider their strategies and explore automation options to mitigate risks associated with labor shortages. 7. Historical investment trends. The report references historical data from the U.S. Bureau of Economic Analysis indicating a significant increase in FDI over recent years, particularly in manufacturing. This historical context is essential for understanding the trajectory of FDI and predicting future trends. Investors can use this information to develop more informed forecasts and strategic plans based on past performance. 8. Role of sovereign and public investment funds. The report mentions that sovereign wealth funds and public pension funds manage a combined $34 trillion targeting direct FDI in infrastructure and energy. This detail is significant as it highlights the potential for large-scale investments in these sectors, which may drive innovation and infrastructure development, thus creating a more favorable environment for private sector investment. 9. Emerging markets and the global south. The report notes that persistent protectionism in developed countries may push FDI towards emerging markets, particularly in the global south. This shift could present unique opportunities for investors looking to diversify their portfolios and tap into growing markets. Understanding the implications of this trend could lead to strategic investments that capitalize on the economic growth of developing nations. 10. Investment in services versus manufacturing. The report points out that investments in services now account for a significant portion of total FDI stock, outpacing investments in manufacturing. This trend suggests a shift in where value is created in the economy and highlights the importance of service-oriented strategies for businesses. Investors should consider reallocating resources to take advantage of this growth in service sectors, which may offer higher returns in the long run. In conclusion, the report presents a wealth of insights that go beyond the headline figure of a 50% rise in FDI. By examining the underlying factors driving this growth, as well as the associated risks and sector-specific dynamics, stakeholders can make more informed decisions that align with the evolving landscape of foreign investment in the U.S. The significance of these insights lies in their potential to shape strategic planning and investment approaches in an increasingly complex global economy. Ignoring these nuances may lead to missed opportunities or increased vulnerabilities in investment portfolios. In-depth analysis of the expected 50% rise in foreign direct investment in U.S. startups by 2026. 1. Growth projections and economic context. The anticipated 50% increase in foreign direct investment (FDI) in U.S. startups by the end of 2026 is underpinned by a broader recovery in global FDI, which is expected to be modest and structural rather than expansive. The United States remains a primary target for this recovery due to its favorable corporate tax policies and a shifting landscape in global trade dynamics. According to FDI intelligence, this recovery is influenced by a projected stabilization of inflation and improved economic conditions, with global growth expected to hold steady at around 3.2%. In 2023, the U.S. saw a notable $227 billion increase in foreign direct investment, predominantly focused on the manufacturing sector, which continues to be a significant draw for international investors. The forecast for 2025 suggests that as global economic conditions improve, coupled with policy changes aimed at fostering an investment-friendly environment, the U.S. could witness a substantial uptick in FDI. The reduction of corporate taxes to a global minimum of 15% is also a critical factor that is likely to attract market-seeking and barrier-hopping investments. 2. Sectoral focus and investment drivers. The sectors poised to benefit most from the expected rise in FDI include technology and automation, renewable energy, communications, and semiconductors. The surge in investment in technology and automation, particularly within manufacturing, is reshaping the landscape as traditional labor-intensive roles give way to automation and AI integration. This shift not only enhances productivity but also aligns with global trends towards digitization and smart manufacturing. The renewable energy sector, while anticipated to experience slower growth than in previous years, remains a focal point for investment due to the increasing global emphasis on sustainability and climate initiatives. In contrast, sectors such as real estate and transportation are expected to see stagnation, highlighting a significant shift in where foreign capital is likely to be directed. The drivers of this investment surge are multifaceted, including easing restrictions on FDI, the implementation of new investment-friendly policies, and an overall favorable investment climate in the U.S. These factors collectively create an environment ripe for foreign investors seeking to capitalize on emerging industries, prompting a shift towards capital-intensive investments rather than labor-driven projects. The ongoing volatility in the global economic environment characterized by uncertainty and complexity, often referred to as VUCA, necessitates that stakeholders remain vigilant. While the potential for significant FDI growth exists, understanding and mitigating these risks will be crucial in capitalizing on the opportunities presented. 4. Future outlook and strategic implications for stakeholders. Looking ahead to 2026, the projected growth in FDI comes with both opportunities and challenges. Stakeholders, including policymakers, investors, and business leaders, must navigate this evolving landscape strategically. The anticipated increase in investments in technology, renewable energy, and automation presents a chance for U.S. startups to leverage foreign capital to drive innovation and growth. For investors, understanding sectoral trends and aligning investment strategies with emerging opportunities will be imperative. This may involve focusing on sectors that are expected to see heightened FDI inflows while remaining adaptable to changing economic conditions and geopolitical landscapes. Overall, while the expected 50% rise in FDI in U.S. startups is promising, it is essential to consider the underlying economic conditions, sectoral dynamics, and potential risks that could influence this trajectory. As the investment landscape evolves, a proactive and informed approach will be key to maximizing opportunities and navigating challenges in the global FDI arena. 1. The Ford Motor Company's investment in the United Kingdom, 1980s to 1990s. In the 1980s, Ford Motor Company made a significant investment in the United Kingdom, establishing new manufacturing plants that would create thousands of jobs. This investment was part of a broader strategy to capitalize on the UK's favourable trade agreements within Europe. As a result, Ford transformed the UK into one of its key manufacturing hubs outside the United States. This case illustrates the impact of favorable investment climates where multinational companies can leverage local resources and labor to increase production efficiency and market access. 2. The rise of Japanese investment in the United States, 1980s. Throughout the 1980s, Japanese companies, particularly in the automotive sector, began to invest heavily in U.S. manufacturing. Companies like Toyota and Honda established production facilities in the U.S., creating jobs and contributing to the local economy. This influx of foreign direct investment was driven by the need to circumvent trade barriers and tariffs, as well as to better serve the growing American market. The establishment of these plants not only boosted the U.S. manufacturing sector but also led to the transfer of technology and practices that improved productivity. 3. China's Belt and Road Initiative, 2013-present. Since its launch in 2013, China's Belt and Road Initiative (BRI) has led to significant foreign direct investment across various countries, particularly in infrastructure projects. The initiative aims to enhance global trade routes through investment in roads, railways, and ports, effectively linking Asia with Europe and Africa. This large-scale investment strategy demonstrates how a country can influence global investment flows, with China positioning itself as a major player in international development. The BRI has encountered both support and criticism, reflecting the complex geopolitical landscape that foreign direct investment often navigates. The anticipated 50% rise in foreign direct investment (FDI) in U.S. startups by the end of 2026 is set against a backdrop of evolving global economic dynamics, technological advancements, and shifting geopolitical landscapes. This analysis highlights three key industry sectors that are expected to drive this growth: technology and automation, renewable energy, and semiconductors. 1. Technology and automation. The technology sector, particularly in automation and artificial intelligence (AI), is poised for significant growth in FDI. As industries increasingly adopt automated solutions, the demand for investment in advanced manufacturing technologies is expected to surge. The integration of industrial robotics and AI into production processes is transforming traditional manufacturing, creating a landscape where foreign investors are keen to capitalize on the U.S.'s leadership in technology innovation. Future outlook: by 2026, FDI in technology and automation sectors is projected to escalate as international investors seek access to cutting-edge innovations and skilled labor in the U.S. The trend toward automation will likely lead to a shift in investment strategies favoring capital-intensive projects over labor-intensive ones due to tightening immigration policies and rising labor costs. 2. Renewable energy. The renewable energy sector is another focal point for FDI growth. With increasing global emphasis on sustainability and climate change mitigation, the U.S. is likely to attract substantial foreign investments in solar, wind, and other renewable technologies. The shift towards a green economy is supported by favorable government policies including tax incentives and funding for clean energy initiatives. Future outlook: by the end of 2026, the renewable energy sector is expected to see robust FDI inflows driven by both market-seeking and strategic investments. As countries aim to meet their climate commitments, U.S. startups in this sector will likely become appealing targets for foreign investors looking to diversify their portfolios and enhance their sustainability efforts. 3. Semiconductors. The semiconductor industry remains critical in the global technology supply chain, and the U.S. is a key player. The ongoing geopolitical competition, particularly between the U.S. and China, has intensified the focus on semiconductor production, with the U.S. aiming to boost its domestic capabilities. This strategic importance will attract foreign investments, particularly from nations looking to secure their technological supply chains. Future outlook: by 2026, FDI in the U.S. semiconductor sector is anticipated to rise sharply as companies seek to establish or expand their manufacturing capabilities within the U.S. This trend will be further fueled by public-private partnerships and government incentives aimed at enhancing domestic production and reducing reliance on foreign suppliers. Conclusion: the projected 50% increase in FDI in U.S. startups by 2026 is driven by the convergence of technological advancements, policy shifts, and the global push for sustainability. Key sectors such as technology and automation, renewable energy, and semiconductors will likely see the most substantial inflows, reflecting both the opportunities presented by the U.S. market and the strategic interests of foreign investors. However, this optimistic outlook must be tempered with caution. Rising geopolitical tensions, potential supply chain disruptions, and domestic policy challenges could pose risks to this growth trajectory. Stakeholders must remain agile and responsive to these dynamics to capitalize on the burgeoning FDI landscape, ensuring that the U.S. continues to be a prime destination for international investment in the coming years.